Well, if you look at since the reaction of the war, the S&P 500 is almost unchanged since this conflict started. So I think there's been, if anything, quite a bit of optimism. It's going to be a relatively short endeavor. If you really look at the S&P 500 has been resilient. So as people look at the cone of outcomes and the duration of this, you're expecting and you're going to see some chop. So I think as we evolve, it's probably going to be realized that it's going to take some time to sort this out. And when oil prices go up and supply chains get questioned and the discount rate goes up for geopolitics, this is a geopolitical shock and it's going to take time and be volatile. So today we're on the negative end of that and we'll have to see how it plays out. In the short term, it feels like there's a real focus on oil and supply chains. And so clearly when you start to see different attacks and questions on infrastructure, key shipping lines, ensuring key shipping lines and routes and assets, the supply chains are being strained. And if oil prices are going up and vols going up, there's a reaction to that as a geopolitical discount rate that is being a bit more elevated today. And we'll have to see how oil shakes out. And clearly there's going to be uncertainty, and this is a bit day to day and headline driven. I think markets can deal with headlines. Markets have a bit more issues dealing when supply chains get disrupted, because that starts to impact economic activity, GDP, inflation, and that starts to spark more market response. So again, this is a difference between headlines and supply shocks and supply chains.